Hello, my dear students. Welcome to all in my virtual class. I am Shahjalal Ahmed Pial, lecturer of Finance and Banking, Milestone College. Today I will discuss about internal rate of return. This is the very important topics of capital budgeting techniques. This is my lecture number 9. Let's go start in the class. Internal rate of return. Internal rate of return is the most acceptable method of capital budgeting techniques all over the world. IRR is one of the most popular capital budgeting techniques. IRR considers what discount rate will be needed to produce an NPV of 0 for the project. So we can say that IRR equal rate of return or discounting rate that makes NPV equal 0. Calculation of IRR. There are no direct formula for calculation of IRR. Determining of IRR is a somewhat difficult method. Most of time we use following methods for determining IRR. Using hit and trial method or trial and error method, linear interpolations formula or spreadsheets is another financial calculator. Dear students, we cannot use financial calculator and spreadsheet for calculating IRR. We only use trial and error method for calculating IRR. Decision rules for independent projects. When IRR is greater than cost of capital or required rate of return, then we will accept the project. Otherwise, when IRR is less than cost of capital or required rate of return, then we will be rejected the projects. For mutually exclusive projects, when comparing two or more mutually exclusive projects, the projects having highest value of IRR should be accepted. Formula. IRR equal LDR plus PNPB divided by PNPB minus NNPB into HDR minus LDR. Here, LDR stands or equal lower discount rates and HDR means higher discount rate. PNPB means positive net present value and NNPB means negative net present value. Determining the internal rate of return. For determining of IRR, we have to calculate NPV in 2 times. To determine the internal rate of return, first we have to determine the present value or NPV in 2 times. One positive NPV and another negative NPV. Dear students, look at the problem number 1. Rohima company is considering an investment proposal to install a new machine at a cost of taka 50,000. The facility has a life expectancy of 5 years and there no salvage value. The cost of capital is 10%. The estimated cash flows after tax are as follows. Year 1, 2, 3, 4 and 5 CF80, that means cash flow after tax, first year in 10,000, second year 10,450, third year 11,800, fourth year 12,250, fifth year 16,750. Now we determine the internal rate of return from these problems. Given that in the questions initial investment or NCO taka 50,000, expected life or N equal 5 years, cost of capital K equal 10%, we break 10% equals 0.10. Cash flows after tax for 5 years, first year taka 10,000, second year taka 10,000 and 450, third year taka 11,800, fourth year taka 12,000 and 250 and fifth year taka 16,750. We will be using present value interest factor. This is the chart of present value interest factor. Column 1 year 1, 2, 3, 4 and 5. Column 2 CF80 cash flow after tax and column 3 present value interest factor at the rate 10%. It is given in the question cost of capital is 10%, and this is the formula of present value interest factor, PV of cash inflows. Dear students, look at the table of PV factor. First year we get this value from using this formula. 1 divided by 1 plus K means 0.10, 0.10, power 1 for first year, power 2 for second year, power 3 for third year, and power 4 for fourth year, and power 5 for fifth year. And now we 10,000 multiply by 0.90909, then we will get the value 9,090.90. And second year 10,450 into 0.82644, then we will get the value 8,636.30. And third year 11,800 into by 0.75131, then we will get the value 8,800 and 65.46. And fourth year 12,250 into 0.68301, then we will get the value 8,366.87. And last year 16,750 into 0.62092, then we will get the value 10,400.41. Now we total all present value of cash inflows, then it will be taka 45,300 59.94. Now we less the NCO. NCO means initial investment 50,000 and NPV equal negative 4,640.06. Dear students, we know that for determining IRR, we have to need positive NPV and negative NPV. Now we found the negative NPV and we also calculate positive NPV. At the rate of discount rate is 10%, then NPV is negative 4,640.06. Now we need to reduce the discount rate to make the NPV positive, because discount rate and NPV has inverse relationships. If the discount rate increase, then NPV should be decreased. Otherwise, if the discount rate decrease, then NPV should be increased. So we will must trial and error method to determine this discount rate for positive NPV. We need a positive NPV for determining IRR. Dear students, look at the table. This is the trial and error method table. Year 1, year 1, 2, 3, 4, and 5, CF80, 10,000, 10,000, 450, 11,000, 800, 12,000, 250, 16,750. Assume that the discount rate is 8%, then first year will be taka 9,259.26 using this formula. And second year, third year, fourth year, fifth year also we find out using this PV factor formula. Now total present value using 8% discounting factor is taka 47,989.55. Now we less the NCO value 50,000 and we will get NPV negative 2010.45. Now we another trial for positive NPV at the rate of discount rate 6%. Then the total present value of NPV is taka 50,000 and 861.64 and less NCO 50,000. Then we will find the positive NPV taka 861.64. Dear students, the internal rate of return is situated between 8% to 6% because 8% NPV is negative and 6% NPV is positive. Between 8% and 6% are middle point or nearest point is the IRR. We found the IRR from this formula. IRR equal LDR plus PNPB divided by PNPB minus NNPB into HDR minus LDR. The students look at the formulas given. Lower discount rate means LDR. Lower discount rate means LDR, and higher discount rate means HDR equal 8% and positive NPV at 6% discount rate 861.64 and negative NPV minus 2010.45. Dear students, putting the value in the formula, LDR 6 plus P and PB means positive NPV 861.64 divided P and PB also 861.64 minus into minus NNPB minus 2010.45. Now look at the value 861.64 plus minus into minus equal to plus 2010. Now 6 plus 61.64 divided by 2872.09 divided into 2. Now we found the value plus 6 plus 0.60 equals to 6.60%. This is the value of IRR. Now the decision is for independent project IRR higher than cost of capital or required rate of return equals to accepted. Otherwise, IRR less than cost of capital or required rate of return will be rejected. In this project, result is IRR 6.60% and cost of capital is 10%. So the IRR less than cost of capital. So the company should be rejected the project because this is a loss project. So my dear students, I hope all are understood how to calculate IRR by trial and error method. That's all for today. Goodbye.